Hello everyone, this is King Helks, and in this video we're going to be going over the model, right, the strategy that we are going to be using for entries and exits in order to make a profit. In the previous videos we've gone over a couple of concepts that are meant to help you understand technical analysis and bring you up to par with how price is delivered, right, the framework, things to look out for. So in this video I'm going to be showing you how to make entries, what to look out for when making entries, and why we do that. So essentially this is the setup, this is the model that I trade that has made me profitable, is the model I've used to pass the prop firms I've gotten funded with in these past few months. So let's get right into it. So rules of entry, a very simple model for profitability. Now this is a very simple model, and if you're able to understand it and work with it, you're going to be profitable in no time. Trust me, don't try to overcomplicate it. There's a reason I said a simple model for profitability, because the problem is people tend to be anti-contrarian in the sense that they would think there's something that I've left out, right, or something I'm not saying regarding it, but I'm taking this step by step, and everything I've detailed out here is what you need, right, to be consistently profitable on the charts. And of course there's going to be a couple of more videos in this series, so let's keep going. And after this video you go back to your charts and you'd be shocked at how often these things repeat themselves, and the multiple opportunities, right, the multiple trade opportunities that come your way on a daily basis. So without further ado, let's get right into it. Now first of all, before we go into the model, I want to introduce you guys to something called top-down analysis, right? So from the name top-down analysis, it means going from something bigger and coming lower, right, or going from above and then coming below. So this involves technically analyzing institutional order flow or market structure on the higher time frame, right, and then going to a time frame lower than the higher to define higher time frame price action and establish your trade idea, and then going to a much lower time frame to refine entries after a trade idea is validated. Now this is what it looks like. So you go to the daily time frame to outline market structure and institutional order flow. Institutional order flow is just another term to refer to the direction of the market, right, where price is heading to, right? That's institutional order flow. So you outline that market structure on the daily, right? Then you move to the 1 hour to establish your trade idea that's been refined from daily. So let's say you're on the daily time frame and you've seen that we formed a higher high and we have retraced into a fair value gap at discount, right? So you've already outlined your market structure that now we're looking to go up bullish, right? So you already know what institutional order flow should be now, right? That you're bullish and now you've retraced, and market structure indicates that we should be going for a higher high now, right? So you outline that from your daily. Then you go to your 1 hour time frame. Now this is what top down analysis means. You see, we're on a higher time frame, now we've gone below, so top down, right? So using our own strategy, this is how we're going to be going from daily and then to 1 hour. So TFDS stands for 1 hour time frame. So you now go to the 1 hour time frame to establish your trade idea that has been refined from the daily. Now the daily has really big price action, right? So it's not something we want to be trading on. So of course, when you have outlined market structure on the daily, you want to go to the 1 hour and then refine whatsoever it is you've seen. If you've seen a fair value gap on the daily and we're in that fair value gap, what you want to do is when you go to the 1 hour, you want to refine it to the 1 hour, right? You want to refine whatsoever it is you have seen on the daily to the 1 hour. And then finally the 15 minutes to define your entry and exit points for increased risk to reward, right? Because remember, in the previous video, in the last two videos, I talked about how the best way to be profitable, right, is by increasing your risk to reward ratio, not trying to over leverage on your account in the sense that trying to use a big lot size that your account can't handle. No, none of that. Not trying to risk 2%, 3%, no, but by using 1% and having a high risk to reward ratio while still not compromising on your rules, then you'll be consistently profitable, right? So the reason we're going to have 15 minutes is so that we can refine, right, a smaller stop loss, basically, because if we can be able to refine a better entry point on the 15 minutes, it gives us increased risk to reward. All right, so number one, right, what we want to do is we want to identify market structure on the higher time frame, right? Number two, we want to identify external or internal range liquidity that price is trading from, price is trading to. So what does this mean? While on the daily, we said we want to outline market structure, right? I want to what's market structure? Market structure is basically the higher highs, higher lows, right? Lower highs that is being formed, right? And when we're talking about liquidity, we talked about external and internal range liquidity. I talked about how that retracement, right, is in order to come into internal range liquidity and then go to external range, right? So what you want to do is that you want to see, okay, which form of liquidity did price just take? Did we just take external range liquidity in the form of higher highs, right? So that means price is trading from what? External range liquidity, because we have taken higher highs. And you see that we're now retracing, and then you can see that there's a fair value gap now in the direction towards which it's trading. Then you can now speculate that price might be trading to that fair value gap. So where is price trading from? Price is trading from that external range liquidity that just took that higher high or lower low, as the case may be. And where is price trading to? Price may be trading to a fair value gap, right? So retracing to a fair value gap. Or it could also be that price is trading from an internal range liquidity after a retracement in order to go to an external range liquidity, right? Which could be a high, to take out a higher high, or to take out a lower low, or to take out an old high, or take out an old low. That's essentially what we mean by identify external and internal range liquidity. Now, number two, we now want to go to the 1 hour time frame, right, to define, right, a liquidity sweep on the hourly time frame. So assuming you've seen that we have retraced into a fair value gap on the daily, right, you now want to come to the 1 hour time frame. Okay, so when we have outlined a liquidity sweep on the 1 hour, I'll come to this in the next slide. We now want to go to the 15 minutes to define our entries and exits after confirmation on the 15-minute time frame. So let's keep going forward to make sense. Now let's talk about the foundations of this model. Now there's never a significant, or there is no significant move in price. Let me not say never, right? Because sometimes we have what we call news releases, right, that could just take price in this particular direction. So let's get back. We said there is no significant move in price without a liquidity sweep above or below an old high or low, respectively. So there's not a significant move, right? That's one of the basic foundations of this our model, that liquidity should always be taken, because there is no significant move in price without a liquidity sweep above an old high or a liquidity sweep below an old low, as the case may be. So remember that the market makers make their entries when money has been taken from these retail traders. What do we say liquidity is? It's basically money, right? So they are going to make their entries, of course, at the position where people will lose money, right? So where exactly will people lose their money? At old highs and old lows. Those are the liquidity pools. That's where retail set their stop loss, right? Because there's this support and resistance idea that makes them set their stop loss above old highs and old lows. So essentially what these market makers do is that the algorithm will now go there, take out the stop loss, right? So it has purged liquidity, and that is the reason why we said there's not a significant move in price without a liquidity sweep above or below an old high or low. So when liquidity is taken, we expect a significant move in the opposite direction. If you can remember from our accumulation, manipulation, and distribution video, the power of three concept, what is this? This is essentially manipulation, right? So that taking of liquidity is that manipulation. So essentially we are saying that we always expect to see liquidity being taken, right, or a manipulation before our trade idea, right? So when liquidity is taken, we'd expect a significant move in the opposite direction. And the question is, so how do we know when the liquidity is a manipulation, right? Because of course we have multiple old highs, multiple old lows on the charts, you could see that perhaps price has traded a few pips below an old low, or a few pips below an old high, above an old high, and you're like, well, I should get in now since price has probably taken out liquidity. But the thing is, there are so many old highs and old lows on the charts. You need to know what you're looking for, right? So let's keep going. Any liquidity sweep on the charts is useless and not worth our time until there is a valid market structure shift after the liquidity is taken. Now, this just cancelled out a lot of mistakes you will have made. Somebody might see that, okay, we have traded above or below an old high. It could even be a significant one, right? And the person is like, well, I'm getting in now, and then I'll set my stop loss maybe a few pips above that, and that's a sure way to frustration in this market. But when the liquidity sweep, right, is now followed by a market structure shift, then we now know that yes, it's worth our time to pay attention to this. But as long as price has taken out liquidity and has not shifted market structure, you don't do anything, you keep watching, right? So any liquidity sweep on the chart is useless and not worth our time until there is a valid market structure shift after the liquidity is taken. Now, there are many old highs or lows at which liquidity resides. Entering a position after any random liquidity sweep does not provide you with a consistently profitable strategy. However, when a market structure is shifted in the opposite direction of the liquidity sweep, we have a setup worthy of consideration, right? So when we now see that there's a market structure shift that was preceded by a liquidity sweep, right? We now know that, okay, we can now consider this, right? So now remember that a valid market structure shift is characterized by the body of the candle fully closing, right, below or above the higher low or lower low before the liquidity sweep. What does it mean? When we're talking about market structure, let me outline this. When we're talking about market structure, we talked about how this low, right, is not valid, assuming this is a higher high, right? This is a higher high. We talked about how we cannot call this a lower high until what? It shifts to the upside. Then we can now call this what? Lower low. And we can now start calling this what? Higher high, right? This was the previous higher high. So now we also talked about how for something to be called a market structure shift, we need to see the body of the candle doing what? Closing above the old high or below the old low, as the case may be. So the body of the candle must fully close below it before we can characterize that as a market structure shift. Because if the body of the candle does not, then that could be another point at which liquidity is being taken, right? So now remember that the valid market structure shift is characterized by the body of the candle fully closing below, right, a higher low, or above the lower low, okay, sorry, or above, okay, I messed this up, let me fix it. All right, so below the lower low or above the higher high, right, that was formed before the liquidity sweep. Now let me explain this. So assuming we have price action trading here, right, so we have a lower low that is being formed over here, then a lower high, then a lower low, right? Now what is this essentially? This is a what? A lower low that was formed. Now assuming price now takes out liquidity over here, right, we can only say we have a market structure shift when this lower low, right, before the liquidity was taken, is broken. So when this happens, right, we now have that market structure shift. Now assuming you have a scenario like this, you have a scenario like this, right, and then something again now happens over here, and then another one here, and then we now shift here. Somebody might call this what? Somebody might call this the market structure shift, but no, look at the point at which we took out liquidity, right? We took out liquidity here. Now where was the lower low, right? We need to look at the low that actually sent price to break that liquidity, and that was this one, not the one that maybe was formed after liquidity was taken. You want to look at the one that sent price to take out liquidity, right, being this one. So even if there's a shift here in this immediate low here, it's not our market structure shift that we're looking for, right? We want to look for the one that took send price to take out that liquidity. That's when we can now characterize this as a market structure shift, when the body of the candle closes below it. So let me get rid of this and show you a buy side example. So for a buy side example, assuming we are forming these higher lows and higher highs, right? And then we take out liquidity, right? The only moment at which we want to focus on this liquidity sweep that was taken out is when there's a market structure shift, right? Above this high, above this higher high, right? This higher high that same price to take out this liquidity. Then we can now say, okay, this was the point at which liquidity was taken. This is the point at which we have a market structure shift. When the body of the candle closes above it, right? So if the body of the candle closes below it, even by a pip, we don't have a market structure shift. But if the body of the candle, you can see that the straight line delineating the top, right, of this higher high to the price action over here, you can see that there's a body there. Then we have a market structure shift, right? So let's keep going. Still talking about foundations of the model. Number 3, after a market structure shift, what do we look for? We look for a displacement in the form of a fair value gap in the recently created price range that shifted market structure. So this was the trade that was going on, right? This is our market structure shift. What's our price range? This is the price range, right? Because liquidity sweep was here, right? So in between here to here is an uniform price range. So we are looking for a displacement in the form of fair value gap. We are looking for a fair value gap within this range. So in the recently created price range that shifted market structure. Let's keep going. Remember that price moves from external range liquidity, that's ERL, to internal range liquidity, IRL, in its delivery. So after taking out external range liquidity, we look to see a retracement to internal range liquidity in the form of fair value gap before the significant move unfolds. So what just happened here? We've taken out external range liquidity by shifting market structure over here, right? And so we are looking to retrace into internal range liquidity in the form of fair value gap. Now I know you're probably thinking, well, we also took out external range liquidity and we also take out external range liquidity here. So how does that? Well, it does not matter. Now you have to understand the model, right? So this is essentially the model we're looking for. You don't want to try and overanalyze things. You want to look at what price action does consistently, and this is what price action does consistently. After we've shifted this market structure, we're now expecting a retracement into internal range liquidity in the form of a fair value gap. I'm sure you can already remember what the fair value gap is. If you haven't, go back to the previous video and understand it. So however, a price range could have numerous fair value gaps, thus confusing to speculate, right, which fair value gap price will trade from. So in between this price range, there could be a fair value gap over here, there could be a fair value gap over here, there could be a fair value gap over here. Thus, we look to further refine by eliminating low probability fair value gaps that are of no concern to us. So how do we do that? Now I don't want to erase this because I still want to make an example with it. Okay, let me erase it and I will make the illustration over here. So we've already said that there could be numerous fair value gaps within that price range that shifted market structure. So how do you know which one you want to be buying from? That is where premium, discount, and equilibrium comes in. Do you see how everything we've discussed in the previous videos are all coming to play over here? Price delivery, consolidation, expansion, retracement, it's coming in here, right? Accumulation, manipulation, distribution, it's all popping up here. Some of the things I don't even need to say themselves. By virtue of how I'm explaining this, and when we go on the charts, you see how everything is just coming together, right? So now we have this over here, right? And we have a bunch of fair value gaps all around town. And you're confused. You could have like even 5 fair value gaps, or you could have like a big fair value gap here, a big fair value gap here, and you're wondering, well, where am I looking to enter a position from, right? So you want to establish your premium, discount, and equilibrium of that range, and then you use your Fibonacci tool to establish that PD, that premium and discount. So you put your Fibonacci over here to over here. What you want to do when you're putting your Fibonacci is that you want to put it from the body, the lowest body of that range, to the highest body of that range. When I say body, I mean body of candles. You don't want to put it from the wick to the wick. You want to put it from the lowest body of that range to the highest body of that range, right? So for buy orders, you are going to look for fair value gaps in what? Discount. So when you set your Fibonacci tool, and assuming that's the midpoint, assuming right over here is our 50% equilibrium, right? You're now looking for the fair value gaps that fall within discount. Now you see you have eliminated all other fair value gaps that are above 50%. So for buy orders, you want to look for the fair value gaps that are discount, and for sell orders, you want to look for fair value gaps that are in what? Premium. So this is a buy example, right? You're looking to long. So for a sell example, let's say this is what we have over here, right? So we're now coming back, and then there are a bunch of fair value gaps over here, You put your Fibonacci from the high to the low, and let's say this is our 50%, right? You're only going to be looking for fair value gaps. You will not consider this one. You only consider fair value gaps that are at what? Premium. This is premium. This is what? This is discount. This is 50%, right? So you want to only consider fair value gaps that are premium when you're looking to sell or go short, right? While when you're looking to buy, you want to consider fair value gaps that are at what? Discount, right? So any fair value gap between premium is none of your concern. Assuming there's a scenario whereby there's no fair value gap in discount, right? You're looking to buy, and there's only fair value gap in premium, you simply don't take the trade, right? There's a reason this video is titled rules of entry as well. These are rules, they are laws, right? Towards the end of this video, I'm going to show you the rules, things that if they don't appear on the chart, you simply do not enter. Why? Because you can go and backtest, and based on your backtest data, look at it, you will see that the most high probability trades come when these things are in alignment. They are confluences to a high probability trade setup. As a trader, what you want to do is that you want to enter trades that, based on previous data, have a high probability of playing out. They might not work out, right? But then you have speculated based on previous data that this is what price is more likely to do over another thing, right? And so things or criteria that do not show up, right, will now let you know that, okay, this trade setup is not high probabilistic right now, right? So if any of these rules is negated, one thing is not there, right, you simply do not enter. Or if all of them are not there, and maybe you just see, let's say there are 5 rules, and you only see 3 popping up, well, all 5 must be there for this particular model I'm teaching you. All 5 must be there. All right, so let's keep going. Still talking about foundations of the model. It's crucial to always remember the theory of time and price that governs us. I talked about time and price in the last couple of videos, and I said that the time and price confluence is one of the biggest confluence you could have, because there are certain characteristics within distinct time, right, within particular time, right, that will help us understand what we are going for. So these kill zones are very important. We discussed the London kill zone and the New York kill zone, right, and the times are over here. So there's always going to be a variation in the time during daylight savings, right? You can go and Google more about that. But right now we are not on daylight savings, so the time presently, Nigerian time, we're using 8 to 11 a.m. as our London kill zone, and 1 to 4 p.m. as our New York kill zone. But by March 2024, we are going to go to 7 to 10 a.m. and then 12 to 3. That's Nigerian time. All right. So any high probability trade setup, what risking on will fall within our defined ICT kill zones. So any trade setup that does not fall within these kill zones is simply not a high probability trade. It might play out, don't get me wrong, but what is the percentage of time that those trade setups will play out when not in a kill zone is very low, right? So you might be lucky enough to enter one particular time that doesn't fall between the London kill zone or New York kill zone, and you'd have this false notion that I can enter even when it's not a kill zone, and you might get it once, you might get it twice. That's luck. Believe you me, you can be lucky in the markets for weeks. You can be lucky in the markets for a month. I was lucky, like when I funded a live account about, I think, a year and a half ago. I was lucky for 2 weeks straight. I was flipping the account, and then my log ran out. Right. So you can be lucky, but what we're doing here is we're trying to establish something that brings you consistent profit, right? That sets you up for profitability in the long run and consistently, right? We're not looking, if you're looking to get rich quick, you might as well back out now because it doesn't work that way. All right, so our entries must be during any of these kill zones, either London kill zone or New York kill zone. Now, it's important to note, however, that liquidity sweep and market structure shift could happen outside of these kill zones, right? So those two things, liquidity sweep and market structure shift, they can happen outside of these kill zones. But what's important to us is that our entry, right? The moment we are going to execute our order, whether our buy order, our sell order, even our buy limit, we need to know that okay, our buy limit should be triggered during kill zone, right? So it should always be during kill zone, our entries. Okay, at what point is our trade idea rendered invalid? So now price has done its thing, right? Let's say we took out liquidity over here, we have shifted market structure, price has returned to discount, we're entering from a fair value gap, we're looking to buy from here, right? So at what point will we say that, at what point will we set our stop loss is what we're trying to say. Because what you want to do is that you want to set your stop loss at a point of invalidation, at the point that you know that if price goes to, then that means my trade setup is rendered null and void. So at what point is our trade idea rendered invalid? Remember our understanding of order blocks. We talked about order blocks in liquidity and reference points, right? About how they're the last up or down candle prior to a move that shifts market structure higher or lower, right? So in this case, when buying, we set our stop loss below the low of the significant bullish order block that was formed, right, after or during the liquidity sweep. So let me get rid of this and put it on the cleaner slide. So let's say when we took our liquidity here, right, there was a very significant last down candle before the up candle, right, that started taking us higher to shift market structure. Now this is our order block, right? The last down candle. This is our order block, right? The last down candle prior to the up move. So when buying, we set our stop loss below the low of the significant bullish order block that was formed during or after the liquidity sweep. I said during or after because you can see that this one, right, was what? After the liquidity sweep, right? So this is our bullish order block. The high and the low is what you want to mark. Remember, high means the high of the week, low means the low of the week. It's important you know that, not the body of the candles. The body of the candles is, what is it, opening price and closing price, not high and low. So the wicks are the high and low. So in this case, if there's a wick here, that is the low, right? So you want to set your stop loss at the low when buying, because when price breaks this fair value gap, assuming you enter from this point, assuming you enter from this fair value gap here at discount and you're expecting to go long, but instead price comes, price can do a lot of things over here and still go your way. But if price drops below this other block's low, then the trade idea has been rendered invalid. It's as simple as that, right? And you want to always make sure that it's at the low of the order block, right? There are always going to be cases whereby there are multiple order blocks and you have problem choosing, but backtesting, going over previous price action data will kind of give you a sense of how to go about things like this, right? Some things, it's not just about the teaching that you watch, right? It's about actually experiencing them. That's why you see a lot of people are not profitable in their first 6 months trading, in their first year trading, in their first 2 years trading. Why? Because they are not consistent on the charts. They are not going to go and check the things that they are actually learning. They don't want to go and see how this thing plays out. They are not back testing. Some people are only forward testing. Alright, no problem. But still, you need to go back test. You need to forward test.
What's backtesting? Going back and seeing previous price action data, what happened in the past, right? How often does it occur? That's backtesting. Establishing where you will have entered, where you will have exited, what risk to reward you will have taken, right? As if you were trading it live. That's backtesting. For testing, you go on your demo account. You will now be trying to see this strategy today. Tomorrow you come back. Next tomorrow. It's a demo, but you trade it like it's a live account. And that's the problem with many people. If they are not live, if they are not trading a live account, they just don't put in that much effort towards trading a demo. I know so a lot of successful people spend a lot of time on demo. I'm not saying every successful person, but I know I spent about a year on demo, a year straight on demo, just practicing this thing, for testing it and back testing things like this, right? Before I actually developed, right, this strategy from the teachings of ICT, right? So when buying, we set our stop loss below the low of the significant bullish order block that was formed after or during the liquidity sweep. So this is the low, this is our stop loss, right? So at this point, trade idea has been rendered invalid. When shorting, when selling, we set our stop loss at the high of the significant bearish order block that was formed after or during the liquidity sweep. Same concepts, right? So liquidity sweep, right? And then we now have the last up candle before it started trading down to come and shift market structure. Now what do we have over here? The low, let me put a wick over here so you can see that. That's what I mean, right? The low and the high forms our order block, right? Now our entry is made from fair value gap, but what, our stop loss is below or above the order block. So say we entered from this fair value gap over here at premium, and it would look something like this, right? So we enter from this point, and this is our entry, this is our entry essentially, this is our stop loss, and then we are looking to take profit somewhere over here. So if price comes and break the high of this order block, then our trade idea has been rendered invalid. So that's how to set our stop loss using this model. Now, at what point do we look to take profits? We look to take profits at old highs or old lows, right, of the direction towards which we're trading. So to increase risk to reward ratio, we can establish premium or discount of the range opposing our trade idea, right, or trade setup, and look to exit at the highs or lows of the fair value gap that could send price in the opposite direction. What does this mean? So let's say there's a big move over here that happened a while back, right? And assuming this is it's 50%, and there's a fair value gap over here that price never returned to, but this is the 50% of that range. And then us, here we are on a particular day, price took out what, liquidity over here, shifted market structure, and we entered over here. I'm sure this is making sense. And we entered over here at fair value gap on a discount to go long, set our stop loss over here, right? And let's say along the way there are some old highs over here, right? Now of course you go enter over here, set your stop loss over here, and exit on this high. But with experience, you'd come to see that price will go all the way from this high to go, because now this is another setup over here, you get. So since that's another setup, if you have actually built the stomach for it, right, and have had the necessary experience to back it up, you'd see that this old high, maybe to offer, let's say 1:2 risk to reward, but there's probably going to be another high here, right, at the point of this fair value gap, because now since this is the setup that's opposing our own setup, you know that price is going to want to, if it's going to go for a sell, price is going to want to go to premium to enter a fair value gap and then go down. So you want to exit at a high prior to this fair value gap, or at the low of this fair value gap, or a few pips before the low. And so at this point you're out. So let's say this point gave you a 1:2, and then this point gave you, let's say, 1:3. You see, just increase your risk to reward. But don't be over greedy though. I've seen things like this burn people. You need to do it within actual price action data that you're looking at, not because you want it to. Sometimes you see that that's not what price action is saying, and yet you'd want to do something like that. Don't do it, right? So, but in this case, you can clearly see that if we are indeed going to go short, price might go short from this area, and so you look to take out your positions, or you can take out partials over here at this high, take out other partials at this high, and then wait for it to reach this low. That's as your final take profit point. So I'm sure this makes sense right now. So let's keep going forward. That's pretty much it. There's no rocket science to it. That's the model. So let's give the rules. The rules of entry. Number 1, liquidity sweep above or below a 1 hour high or low. So on the hourly time frame, there should be a liquidity sweep on that 1 hour time frame. Then a market structure shift on the 15 minutes time frame. So after that 1 hour, after liquidity is taken above or below a 1 hour candle, right, you move to the 15 minutes time frame, and if there's a market structure shift, then we move to rule number 3. You establish a premium and discount, right, of that 15-minute range that shifted the market structure using body of the candles, not wick. What I mean by this is to establish the premium and discount, right? Market structure shift over here. Let's say this is a wick and this is where the body is. Let's say this is a wick and this is where the body is. When using your Fibo, you don't want to put your Fibo from the wick here to the wick here. No. You want to put your Fibonacci to from the body of the candle, right? The lowest candle there is, right? Here, and then the highest candle there is the body, right? That's how you want to put your Fibonacci to, not from week to week. Weeks can be manipulated depending on what service is offering your chart data, right? But bodies cannot be manipulated like that. So from the body to establish your premium discount on the 15 minutes range. Let's keep going. Outline the fair value gap that is in premium for sales or discounts for buy as your entry point. We've talked about that in the previous slides. And number 5, ensure you are in confluence with the kill zones during time of entry. It's as simple as that. That's the 5 rules. Liquidity sweep, right? On the 1 hour time frame. A market structure shifts on the 15 minutes time frame. Establish premium and discount on the 15 minutes range, right? That shifted market structure. Then outline the fair value gap that is in premium for sales or discount for buy as your entry point, and then ensure you're in confluence with the kill zones during time of entry. So what we're going to be doing is we're going to be heading over to the charts. I'm going to be showing you guys a couple of examples. I'm not going to take much examples in this particular video. I want to trim down the time. I'm going to make a next video where I'm going to be doing intense backtesting and showing you guys this strategy repeat itself over and over time. Alright, so let's jump over to the charts. Alright, we're on GBP USD charts. Now, in order to show you how I'm not cherry picking this, I'm going to show you, today is January the 1st, 2024, and I'm going to show you a trade that occurred Thursday, December 28th, right? So now I think at the end of this video, I'm going to tell you guys something that you should watch out for. So for now, let's do this, right? So what do we have over here? I said when we're talking about the foundations, about how you should know what market structure is on the daily. As you can see, we're on the daily time frame, right? And so what's our market structure, our immediate market structure? You can see that we have a higher high from the higher low, higher high, higher low, right? And as of Wednesday, you can see that we have taken out liquidity above this high, right? Which could suggest that we might want to go or return, right, into internal range before going higher. I said suggest, right? So you want to look to see if going to the lower time frame, right, there's going to be a trade idea or trade setup that corroborates that. It's something you need to understand as a trader, because these are taking a liquidity, right? These are concepts that you should understand that yes, play out, but could be negated, right? So essentially what we're doing is probabilistic as traders. We are speculating, right? It's not like in school where they'll tell you 2 plus 2 is always 4. In here 2 plus 2 could be 5, it could be 6, it could be 7. You just need to know what times it to turn out 4, right? No, you don't even need to know what times it to turn out 4. You just need to have rules in place, right, that will make you profitable if 2 plus 2 is 4. Does that make sense? Right? So in this case, we know that, okay, 2 plus 2 could be 4 at this point, which means we should be retracing, which means we should go and look for sell opportunities, right? So we now go to the 1 hour. We've identified that we've taken a liquidity and we might be retracing at that point. Might, right? So, okay, let me put on a vertical tool over here. So this is Wednesday that took out that liquidity. So let's go to the 1 hour. Now so this is Wednesday. Now TradingView's chart does not really use our own New York time, right, as the formation of daily candle. So it's counting this as the beginning of Wednesday, but we know from our previous time and price theory that the beginning of our Wednesday is what? 12 a.m. New York time, or 6 a.m. GMT plus 1, right? That's Nigerian time. So these are beginning of Wednesday. So over here, Wednesday, we see we took our liquidity above these relatively equal highs, right? So now Thursday, we want to see if there is going to be a trade setup that supports us going bearish. Now, remember when I said Asian range? Now these are Asian range. I already have it outlined over here. You can go and always be marking it, right? We have the time from here to here. So these are Asian range, and we said that Asian range primarily, right, consists of accumulation of orders above and below, right? A consolidation. Not always, but it's a characteristic to look out for, right? So we now see that after taking a liquidity on Wednesday, price on the 1 hour time frame took out liquidity above these highs. These are kind of relatively equal highs, right? But price took out this high, right? So we can now say that we have a liquidity sweep, a buy side liquidity sweep above these highs, above our Asian range, right? So essentially, what do we have? Accumulation, manipulation, right? Okay. So now what are we now expecting based on our model? Let me paste the rules over here. You need to look at these rules and see that we're not going to break any single rule. By the way, I haven't actually even back tested this, right? So liquidity sweep above, below, 1 hour, market structure shift on 15, establish premium and discount on the 15 minutes range using bodies of candles, outline the fair value gap, ensure you are in confluence with time and price. All right, so let's keep going, shall we? So now we're on the 1 hour. We have seen our liquidity sweep. So now what does the rule now say? Market structure shift on the 15 minutes time frame. So we head over to the 15 minutes time frame. Thursday. Let me bring our rules within view. What's our third? Establish premium and discount on the 15 minutes range, right? Okay, we need to see a market structure shift on the 15 first. That's the second rule. So rule number 1, check. Rule number 2, market structure shift on the 15 minutes time frame. Carry out Fibonacci tool from the highest body of the candle, not from wick. I'm not using the wick, right? To the low of the range that shifted market structure shift. Where's our market structure shift? This is the what? This is the low that sent price to take out this liquidity sweep. So this is the one we're looking for as our market structure shift. You can see that at this point, you see this candle over here did not actually shift market structure. If you at this point had said we have shifted market structure, you're wrong, because we hadn't. You can see that it was just weak. But what do we now have? At this candle, you can now see that there's a valid market structure shift because the body has closed below it. So we can call this our market structure shift, which means now what are we looking for? Rule number 3, establish premium and discount. Okay, I kind of jumped the gun there. Establish premium and discount on the 15 minutes range using body of candles, not wick, that shifted market structure. So this to this, what do we have? 50% over here. We have our 50% over here, as you can see, right? Which means everything above here is premium, everything below here is discount. Now what do we want to do? We want to outline the fair value gap that is in premium for sales. We're looking for sales, right? That's in premium for sales or discount for buy. So since these are premium, where is a fair value gap? Where is it? Where is it? Should we take a pause? Perhaps you find it right here, right? That's some Dora the Explorer shit. Alright, so this is our fair value gap, our 15 minutes fair value gap, and then we've lined this 15 minutes fair value gap. Now ensure you are in confluence with the kill zones. So what is our kill zone for London kill zone? We said it's 8 to 11, right? So let's come over here. Where's 8 o'clock? This 8 o'clock to 11. 8 o'clock to 11. Boom. So everything from here to here, right, is London kill zone. So let me outline this London kill zone. It's a London kill zone. And by the way, I just want you guys to know I actually haven't backtested this. After coming from the PowerPoint, I just hopped on the charts and it was on 15 minutes time frame, and I saw it and I was like, well, what do you know? Because I actually haven't been trading this December. December is not really a month that has really clean price action. If you are to ever take a break from trading, right, let it be December. Carry December as your vacation. Just go off the chart, because currency pairs, which is what we're trading, is not really that clean, does not really have that much clean price action during December. So I have not been trading my funded account this December for the past 2 to 3 weeks. That's the time I've taken to record this course. So anyways, let's get back into it. Rule number 1, liquidity sweep on the 1 hour time frame, right? What do we have? Liquidity sweep above this 1 hour candle. The market structure shift on the 15 minutes time frame. We go there. Market structure shift on the 1 hour time frame. What do you know? See it right over here. Establish premium and discount on the 15 minutes range using body of candles, not wick, right? So from this point, right, to this point, 50%. We have established premium above here, discount below here. Outline the fair value gap that is in premium for sell. That is it right over here, our 15 minutes fair value gap. Then ensure you're in confluence with kill zones. These are London kill zone, 8 o'clock to 11 o'clock GMT plus 1. So after we form this fair value gap here, right, you now want to ensure you are trading as soon as we hit, okay, as soon as we hit the low of this fair value gap, you want to come and trade it, right? Okay, so this is actually our fair value gap, right? So at this point, at the low of this fair value gap, and exactly the low of this fair value gap is the high of this candle, right? What's the high? 1.28. Look at the high over here, 1.28078. 1.28078. So you want to ensure that you are trading from the low. Don't try to be greedy and put your entry point here, or put your entry point here. It's all fair value gap, you would say. It's not. Price can be so precise that it will enter this box, this fair value gap, by 1 pip and drop, and it will make a 100 pip trade, and you'll be crying. You were right, but you were selfish, or you were arrogant. You wanted to show you could beat the market. You're waiting for it to come to half, because you're an A student and you always beat the market. So always at the low. As a prop farm trader, I've even come to realize it's better to set my order right below, right, like before the entry point, right, so that I don't get kicked out by slippage. go Google what slippage means if you want to know what it is. It's a free course. I mean, there are some things you have to go and do for yourself. Slippage. Go Google what slippage is. Right? So what you now want to do is that you set a short position to over here. Right? Now, what did we say should be our stop loss point? At the high of the order block, right? Or the low of the order block. In this case, it's going to be the high of the order block. What do we say the order block is? The last up or down candle prior to, right, market shift to structure. All right. So in this case, here's something you need to understand. From this candle, this place to this place can all be characterized as an order block. Why? If you move to the 30 minutes time frame, what happens? This candle and this candle join together. It becomes one order block. Right? So all this is order block. This is the high, this is the low. So in this case, where's our low? Where's the high of the, sorry, this is the high, this is the low. Where's the high of the order block? This point right here. Which means if price trades to this point, then we know our trade idea is invalid. Right? So let's set it up. So we have a 14 pip stop loss. Now, to set up our take profit points, you want to go back to the 1 hour to see better market structure before coming to the 15 minutes to refine it. Right? Okay. Or let's go to the 24 hour. You want to see where could be possible points that price will want to start going higher from. Okay. Since I'm overloading my computer. Okay. So something you could do is you could establish 50% of the current range, go to the hourly, right, which is the 1 hour, to further refine it and see points at which price might actually go below. Because if we are looking to go long, you want to see price going what to discount before going above, right? So you now see that this is what our discount point, which means price could trade all the way to this point before start hunting for fair value gaps, because you can see that the fair value gap in the opposing range is now where it's below this low. See, that was the last thing I talked about on this list, right? Okay, so what do we now want to do? Let's get rid of this. Okay, let's move these rules. You can see we followed each and every one of the rules to the latter. Move to the 15 minutes time frame. And now we have a bunch of lows over here, places you could have taken profits. This is me. This is what I would have done. I was not on the charts. I was enjoying my Christmas vacation, right? All these are good lows that you could have taken. At this point, you will have gotten a what? You will have gotten a 1:4.54 trade. So this is a good take profit point, right? Another good take profit point is this low. Right, you'd have exited with a good 5.43 risk to reward. Another good one is this one, but you see you would have had to wait for the next day. So for people who don't like to hold trades, especially since we are day traders till the next day, like there are times whereby since I'm in school, right, I won't want to wait till the next day because I might be writing an exam, a test or whatever, and I don't want my mind to be on it. Right, because see, it's 10 o'clock the next day before we come and hit this take profit point. So sometimes I'll just take out towards midnight. Right, okay, this was 6 o'clock Nigerian time. Towards midnight, I will exit my trade if I see I already have a very significant risk to reward. So at midnight I had 5.43. This is most probably where I will have taken out my profit. Right, so this is me being realistic. Of course, this is also a good point. This is a good point, right? So 7.77 is 7.77 trade, right? So you should be risking 1%. I've already mentioned that. Now let's bring up my calculator. All right, so risking 1% on 7.77, 50 times 7.77, right? I mean, come on. So why do you need to risk more than 1%? You can clearly see that this strategy works, right, and offers really good risk to reward. Now that's why we now came and refined on this 15 minutes, because it now gave us a smaller stop loss range, which, and then the smaller our stop loss range, the more reward we have, right? Because now if our risk was just what, 7 pips, what happened? We have doubled our profits as well. But you don't want to. Here's a quote you should have embedded in your head, right? Don't sacrifice your rules, right, or price action data for what you want. Because you might be like, well, I mean, this is also another block, why don't I just put it here? But, right, something is better to just stick to the rule, and if you're taking out, you're taking out, right? Or let's say you had put it here and it worked out in your favor, price actually gave you 11.53 trade. Guess what? It might not the next time. It's always better to stick to your rules. What's the rule? Above the other block. Assuming there was a very large range actually, and the other block was over here, and you could see many significant other blocks, and you set it above one of them, right? After a number of them, right? It's fine. But at this point, I mean, come on. A 14 pip stop loss is good enough. What would make you bring it over here, right? So stick to the rules. So that's the first instance of this strategy. Let's go to the charts and keep looking for more. Alright, so we're back on the daily. Now I haven't been training December, so some of these things are even pretty new to me, some of these trade setups, because I've not been checking December price action that much. Alright, so but you can see that these things are repeating themselves even on a month that does not have really good price action, right? So when you want to backtest, what I would advise is that you do a free subscription, right? Because a lot of people can't afford TradingView subscription. Do a free subscription, a free trial for 1 month, and make sure you do it on a month that you're going to give it your all, right? Mine was January 2023, right? I knew I was going to be free for most of the month, so I did a free subscription and I backtested, and I was recording myself backtesting, right, to kind of be accountable, right? So make sure you do it on a month that you know you're going to be putting in that effort, right? Okay, so now we just backtested Thursday. Now see Tuesday. Now as of Tuesday, we could see that we have a what? Higher low, which means we are going for what? Higher high. External range liquidity. Okay, so what do we want to be doing? We are still looking for buy opportunities, right? So let's go to 1 hour. Tuesday. All right. So now here is what I want to show you guys. Tuesday, nothing, right? Nothing worthy of notes, because I just checked, right? But now you would see something really important here that will help you understand how to look at price action. Don't just look at what's immediately right in front of you. Look to the left. Look at what happened, right? There's a quote that says you can't really go where you want to go unless you know where you've been, right? It's a very important quote, right? About understanding where you're coming from in order to know where you're going. So in this case, look at this over here. We're still looking to go long, right? Now, as of Wednesday, you can see that price traded, took out numerous pools of liquidity below all these lows, relatively equal lows and all this and whatnot. But if you were waiting to enter and continue going long, you would have missed the trade, because as of this point, we have already taken out that external range liquidity, that daily highs, right? Those higher highs. So look at over here. You would see that on Tuesday, December 26th, this was a prominent liquidity sweep that actually happened. Why? Because after this liquidity sweep, price didn't really come back here. See, so all this, right, was liquidity. We took out liquidity below here in the form of sell side liquidity. Now, what then happened? Let's go to the 15 minutes time frame, shall we? Let's see. So we said we want to look at the high that sent price to take out this liquidity, and in that case it's this one. All right, so let's outline it. So as of this point, we can say that we have a valid market structure shift. Okay, so now what next? We want to establish premium and discount. not established premium and discount. You see that we actually got two setups, in the sense that you could have entered this thing on, okay, no. You know why we can't use this as our 50%? Okay, I wanted to say that we got a trade from here because there was a fair value gap, right? Because there was a fair value gap in between these candles, in between these three candles. But you notice that since we're using this as our range high, we're looking to enter from below this place as our fair value gap point. Why? Because this traded into here before we formed this thing, right? So if we were at this point, what we will have been looking for is below 50% into this fair value gap. But when we now form this high after breaking market structure shift, we are looking to what? Trade below this into this fair value gap, because this is just a part of the fair value gap right now. Okay, I hope you understand me. All right, so you can see that price never really did trade into it until Wednesday. Dun dun dun. All right, so as of Wednesday, this is our new range, and this is what? Premium. This is discount. And what are we looking to do? We are looking to buy from discount. Now, here is a fair value gap at discount that you could have entered from. Here's another fair value gap at discount you could have entered from. I will tell you which one I will have entered from later, but now let's go from this first one, right? So in a case whereby the 50% range is in the middle of a fair value gap, what I technically do is that I enter right from 50%, or since I'm a prop trader, I enter from a little bit above, right, at 50%. So where am I going to put my stop loss? Where did we see? Low of the other block. We did a buy scenario earlier. We did a sell scenario earlier. Now it's a buy scenario. And then let's go to the 1 hour to look at price action very well and refine it to the 15 minutes for our exits. Okay, that was it. Okay, and we were looking to what? Take out this higher high on the daily, right, above this point. Do you see how that trade give us a 1:3, right? A 1:3, very good setup. I hope you guys are seeing how this thing is repeating itself over time without breaking any rules. We did not break a single rule, right? Where are my rules? Where did I keep them? Okay, liquidity sweep above or below a 1 hour low. Right here, market structure shift on the 15 minutes time frame. We saw it right there. Establishing premium discount. We did it right here, right? Outline the fair value gap that is in premium for sell or discount for buy. We are looking to buy, so discount right here. Ensure you are in confluence with time and price. All right, let's do that now. So what's our London kill zone time? 8 to 11. Let's see if we got this or not. 8 o'clock to 11. Come on, guys. Why would you want to break rules when things like this happen on the charts? Right? Now, you might be asking yourself, okay, well, I'm the instructor in this program, and yet I was not trading during December, and yet things were happening like this. Don't I regret it? Not one bit. I absolutely do not regret it one bit. Do you know why? Because as a trader, you need to have discipline, right? Without discipline, you cannot achieve the level of growth, right, that you can achieve from this market without discipline. It takes discipline to be only trading 1 or 2 currency pairs when there are a lot out there. See, I only trade GBP and Euro USD. There's no reason why you should be trading more than one, right? I do GBP and Euro USD because in the next video I'm going to explain why, right? I love having just 2 pairs. I don't trade anything else, just these 2 pairs. Just these 2 pairs. Right, so it was by that same measure of discipline I decided, right? Because I know, right, as an ICT student, that December has shitty price action, right? The institutions have taken off their orders. They've basically gone on winter break and they're going to be coming back January. so I was not supposed to be trading. So I think I executed about 2 to 3 trades at the beginning of December, right? And I realized that indeed the price action was shitty, right? So after like two losses, right, I was down 2%. I now decided, okay, I'm not going to trade anymore in December, and I was going to be off the charts while recording this course. So that's what I did. All right, so let's keep looking for. I think we're going to take one more example, and then we're going to wrap up this video. And I'm going to do another video next, talking about something that will further improve your trading. But I'm sure that based on what you're already seeing from this video, and if you've actually been following along from the previous videos, that you can see how you don't need to be right all the time, yet you'll be profitable, right? So let's look for more examples, shall we? All right, so I've showed you guys some pretty much close to perfect examples, and I want to kind of show you, because forex trading is not perfect, right? Price action can be precise, but it's definitely not perfect, and neither are you. So I want to show you a good scenario that I would have taken a buy, right, but wasn't in confluence with everything. It didn't break the rules, keep in mind, right? But look at this, we had a higher high, higher low, higher high, right? Now typically you would expect a return to 50%. Now we don't have a return to 50%, but our 5 rules still remain intact, and that is why I will still take the trade, right? Because there's a reason why I didn't put the daily having to return to 50%, right? Because price delivery is not perfect, but these 5 rules is what is the closest thing we'll come to, right, to just achieve our high level of consistency. All right, so let's go to the hourly time frame. Okay, first of all, let's outline this over here as the fair value gap, because we are already in a fair value gap, right? We already have pretty much enough confluences, and all our 5 setups were followed, which is why I'll take the trade. You'll see in a few minutes. So this is daily. We have a fair value gap, right? So let's go to the lower time frame. Let's go to the 1 hour. All right, so on the daily time frame over here, you can see that going by premium discount, we haven't traded into discount of the daily range, but what happens, we have traded into the fair value gap, right? And it's a pretty big fair value gap, right? So what I do in a scenario like this is that I will establish the present range, since it's a very large fair value gap, and you can see we are in the discount of that present range, right? Even though we are not in the discount of that particular daily range. But if the 5 rules are intact when a trade setup forms, I will take it. All right, so we traded into a daily fair value gap. That's a very big thing, right? And it now comes at confluences with the fact that we take out our rule number 1, liquidity sweep, on the hourly, right? Okay, so let's go to the 15 to meet our rule number 2. What's our rule number 2 again? Market structure shift on the 15. All right, okay, November 16. All right, so here we are now after our 1 hour liquidity sweep, and then right over here, the high before liquidity was taken, right? We have our market structure shift. So what do we now do next? We establish our premium and discount, right? Establish our premium and discount, and number 4, we outline the fair value gap with discount, since we are looking for a buy. Now we have number 4. Number 5, time and price. Right, so London Kills on is what time? 8 o'clock to 11 o'clock. We clearly don't have our entry within London kill zone, right? So New York kill zone is 1 o'clock to 4 o'clock, and you can see that our entry falls at 15:30. That's 3:30. All right, so this is where we're looking to go long at exactly this low over here, right? That's the high of the fair value gap, and then putting our now here's a scenario. So we're going to set, what I will do is I'm going to set my stop loss below the low of this other block. Why? Because this is 27 pips. For this setup, I typically like the soft spot, right, that I look for is something about, let's say, 25 pips at most, right? So I see a good setup like this and it's offering me 27 pips. I will take it, so I won't bring it over here because I know that this is a very huge gap, right, in between my entry and my exit. So I'll set my stop loss over here and then go to my 1 hour to start establishing what price action is doing there before defining it into my 15 minutes exit point. All right, so November 16th, November 17th. All right, so since this is the high I want to come and take out, this is it over here. We have some other highs too along the way. Now I will have taken this high, but you can see it doesn't really offer us 1:2. Over here we now get 1:2.64. This is a good exit point. I will have been out at around 3 a.m. right? Pretty sweet. Or if you're willing to hold, you end up with a 1:3.59. So typically you don't really see people trying to show you the imperfection of some of these kind of things in the first video, but I don't want you guys to enter into rainbows and sunshine's kingdom by watching this video and then not come back to watch any other video and think that you have a holy grail that will work every single time. It does not work every single time. Because something worked out a particular way before does not mean it will work out the next time. Just like here, you see that our 5 rules remain intact. Our 5 rules should always remain intact. I can't stress this enough. If there's going to be anything else, right, that is not in confluence with your trading, it should not be part of your 5 rules. So here I use the range from here to here to establish my premium discount, right? And it confluenced with the fact that we were in a daily fair value gap, right? And that we had that 1 hour liquidity sweep, right? And we had the 15, so 5 rules were intact, and we still have a daily fair value gap. That was good enough confluence for me, right? So that was why I took the trade. Hopefully you've learned a lot of things from this video. I'm sure everything is coming back together now. Like every piece of the puzzle is just making more sense. So in case there are concepts I mentioned in this video that haven't made sense, go back to the previous videos. You see they make sense. Go to your charts, back test. I can't stress this enough. Open a demo account. It's 2024. Start back testing and forward testing, and hopefully in no time you begin to see consistent profitability trading this. Ensure you stick to the rules though, guys. Ensure you stick to the rules, right? The rules are there for a reason. All right, so I'll see you in the next video. Good luck and good trading.